today, what I would like to do is go over some of the different theories of the business cycle. And then I'm going to be spending a little more time on Minsky, but we're also going to be looking at Joseph Schumpeter's creative destruction theories, and as well as some of Hayek's work on malinvestments and booms and busts. I think it'll be an interesting lecture or discussion, and I hope you enjoy. So again, this talk is on the business cycle. So how do you define a business cycle? Well, a business cycle generally refers to a wave-like fluctuation in the overall level of economic activity. So you might either see it in a circular motion or in an oscillating wave-like pattern, which is probably the best way to understand the business cycle. Things that fluctuate might include national output, income, employment prices. The upshot is that natural ebbs and flows, I can't get there behind me, are what's going on. So again, this is sort of the representation of what the business cycle might look like. And again, it goes along with sort of if you open up any sort of Bloomberg terminal or go on Google Finance and look for the S&P 500 chart or anything like that. So you'd see these sort of booms, expansion, recession, some busts. Sadly that does tend to happen. So that is what we're discussing when we're talking about the business cycle. So an expansion, quite simply, is just the upswing. And typically what you see during expansions are near full employment, net positive growth in GDP. On contractions, you might see recessions, short-term contractions. So on contractions, you might see recessions. During a depression, well, in a depression, you might consider it as a recession lasting longer than 2 years, or GDP losses at greater than, 10%. I think so, yeah. So 10% would be the key. So interesting. I hope you enjoy having me on the screen, although sometimes I may be blocking some of the data or parts of the talk. Okay. Now, one of the interesting things going on, especially when I mentioned the S&P 500, is that now it seems to be, with the advent of financialization, and that's a whole nother topic, but in case you're interested in looking that up as well, we're looking at a disconnect between the S&P 500's growth and when we're talking about issues like near full employment or even GDP growth. So the stock market itself seems to be at an inflection point, or with how they go together, are they running together in terms of growth and unemployment and stock market gains. So a good thing to look at and to further investigate via theories on financialization, if that's what you're interested in. So causes of a business cycle. So causes of the business cycle. We see that there are material causes, ideational causes, and non-market factors. So some of the material factors would be things like, business growth. Think about a new industry coming up, a new sector, like the app boom after the .com boom or things like that. It's like something tangible there, a tangible market, money being made. We're looking at, SEC 10K filings or 13F filings, things of that nature, leading to growth. So there's a sort of a signal, a real market signal to growth, or an actual fundamental to it. Also, on the negative side, you might have underconsumption, deflation, and again, overconsumption, inflation. And so those would be the sort of the material factors, causing the business cycle to move in a certain direction. So material is the first one. Ideational, again, this is more to do with ideas, human sentiment, market sentiment. So is there confidence within the sector? Is it, typically we hear about bulls and bears. So, bullish being optimism. You'll see one in front of the New York Stock Exchange, down in Wall Street, you'll see the statue of the bull, and it's popular around the world. So in Birmingham, they have the bull right in the market center. They have a huge, copper bull as well there. And then there's bearish sentiment as well. So I think there might be a bear in Chicago, right, where the commodities exchange, they seem to go in inverse. So when the stocks are down, sort of the commodities start to increase, there's inflation, and those start to rise. So that would be the bulls and the bears battle there. All right. So again, the point of the ideational one is that the market is also driven by, psychological factors, and those should be taken into consideration as well. Now, some of the non-market factors, you might have, political, economic, more political than economic, and natural. So I would say strikes, agreements, trade, trade laws, trade tariffs. You also have wars, climate and health catastrophes. Obviously, we're going through COVID pandemic. But we've also, in the recent past, we've seen a lot of war spending. So since 2001, we've been at war in the Middle East. So that's another area that's sort of siphoned off a lot of money from development here in the U.S. So again, we see how do we make a balance of all these, of all three of these. And this is the way I've been able to sort of discern what causes the business and what are the causes of the business cycle. So I don't know if I'm going out on a limb, but these are the three that I would identify. So this is my contribution, and correct me if I'm wrong if there are others. There are other scholars that have delineated this way, but this would be sort of my approach, is that there are material, ideational, and non-market factors. All right, so getting to the theories now of the business cycle itself, and we'll look at the way that these are presented, via different theories, briefly. It's not an in-depth approach by any means, but nonetheless, an important overview of some of the general theories that we will cover. So Joseph Schumpeter's historical school, he coined the theory of creative destruction. So in this theory, it suggests that innovations are the source of business fluctuation. So you have sort of like these disruptors in the market. Think of Tesla and the electronic car, or what he's been doing in terms of space travel, or space technology, and also his boring company, which digs holes underground. So is he a sort of a market disruptor? Again, in terms of revolutionizing the sectors that he's working in. Also the cell phone, we could look at, Netflix sort of taking over the entertainment space. And, how does that affect brick and mortar stores like Blockbuster, or even movie chains out there? Do we still go to movies, or do we just stay home and, watch them at home? Well, anyways, just continue down the line here. So an innovation is defined as the development of a new product, a new method, a new process of production, development of an entirely new market, a new source of raw material, a change in the organization of a business, let's say globalization, for instance. So creative destruction also draws a bit on Marx and his understanding of capitalism tendency towards crises. I think that's what it says there, but yeah. So it's a sort of a crisis-based model where you have these, these general periods of growth or something, and then a crash or a huge disruption. And we do see, so to a certain extent, I would agree that there's a lot to be said here in terms of Joseph Schumpeter. And obviously, he's one of the intellectual giants. So, of course. All right. Now, getting to Friedrich von Hayek's the Austrian approach, or the Austrian school, and his theory of overinvestment. And he suggests that business cycles are caused by overinvestment, which also leads to overproduction. Now, monetary overinvestment, this is caused by discrepancies in the interest rate being charged by bankers and the natural rate of interest. So there's a scenario here. Let me try to get out of the way here so I can see these notes. So the scenario, if a bank begins to charge interest rates below the equilibrium rate, then businesses will obviously attempt to borrow more funds. Now, the discrepancy between the two rates, bankers versus the natural rate, will lead to business fluctuations, that is ups and downs. Thus for Hayek, there's a natural equilibrium rate. And typically what he does is he excludes bankers and government agents. He externalizes them from his own models. So it does essentially so the issue with Hayek's theory of malinvestment is he basically admitting that the real world sort of ruins, you know, his own model and the sort of equilibrium model that he's sort of chasing. Again, that's food for thought. So when we compare that to maybe Hyman Minsky's post-Keynesian model, we see sort of what are the pros and cons here. In neoclassical theory, we see that markets absorb disturbances from outside and transform them into displacements from equilibrium. And then you get determinants from a new equilibrium. So this is, you know, Minsky talking about, you know, this sort of approach. Now, thus, in the neoclassical view, disturbances are typically coming from the outside and are responsible whenever the performance of the economy is unsatisfactory. So if something happens to the market, we generally displace the blame in these equilibrium models. And that would go into another topic that I'm also interested in. So I'm always referring you out to different sources. So one of the papers I recently done is in the New Political Economy journal. And that one deals with sort of black swans in the market. And these are typically crises that are unforeseen, large in scale, and really disrupting the economy. And are they being, essentially, is it part of that Hayekian model, a sort of externalized issues or crises that perhaps with different frameworks, analytical frameworks, we could have prevented them, or at least sort of seen them coming to a certain degree, to a certain extent. So what we're looking at here is, are we seeing markets from inside the models or outside the models? And this would go to the question of endogenous versus exogenous view of, you know, markets and the economy. So the interesting part of Hyman Minsky and why I'm attracted to the sort of post-Keynesian approach is that crises are typically baked into the cake. So we see that capital markets, so the three assumptions made here by Minsky is that capital markets will not create a sustained, a stable price for full employment equilibrium. It's just not going to happen. Instead, what we see is that volatility and these huge booms and busts, or at least, you know, recessions and upswings are essential to capitalism, as volatility is how these speculators make money. So again, quite to the contrary of what Hayek is proposing or posits. And lastly, so for post-Keynesians, typically what they see is that markets are intersubjective and social in nature. So finance relies on, and this is Minsky talking again, finance has relied on survey data since the 1980s. And now I added that, you know, we have data analytics, which is essentially electronic spying and data collection. And it's interesting because in the GameStop case, what we see there's more attention on Robinhood, on the app, and sort of their machinations behind the scenes and even their business model. So what came out of the whole GameStop phenomenon with the stock rising to upwards of $300, and I think it actually rebounded back. So now it's around the hundreds or 200s now as I say this, after it had gone down to 40, is that, you know, these Robinhood accounts, what they're actually doing is selling, how their business model is not based on your trades itself, but on their ability to sell your data to larger hedge funds, which then actually could front run your own trades, get this sort of survey data, you know, data analytics, and they could essentially front run your trade before you actually put in your trade, since they're the broker. And they also, you know, they're also the ones that use a lot of the high frequency trading to get in and out of the markets quickly and sort of that. So they're like a day trader on steroids essentially, or if you remember like the the Nintendo remotes with the turbo button. So they have their own turbo button where we're just sort of on analog getting in and out of markets and day trading. So quite interesting to see. Is it rigged? Is it rigged? Well, that would be something that you'd have to decide. But yeah, it doesn't seem like it's completely a balanced thing when you're coming in with a small amount of money and you're sort of trying to day trade. It's really like a sort of a David and Goliath scenario at the very least. Okay, so Hyman Minsky, the 3 stages of the financial instability hypothesis. So again, it seems that a lot of things seem to like to go in 3s. We see that, you know, when we're talking about decor or things of that nature, we see, you know, pair things in 3. So, and I say that to refer earlier to how I mentioned that there are essentially three market drivers. You'd have the material, the ideational, and the non-market. And well, so Minsky also has three stages now of the financial instability hypothesis. So you have the hedge phase. Now this is where you'd want to be in the market. This would be sort of like, if you could say that there's ever an equilibrium point, it would be, this is where you'd want to be ideally. This is where income flows cover your interest and your principal. So in a sense, how the market's operating is based on income flows from the money it generates. In other words, there's actually things being made, services being rendered, and all's well in the market. Now, once you get to the second stage, it becomes a speculative market. So you have sort of speculative finances, what's moving the market forward. So what you see in this phase is that the near-term income flows of firms or within the sector that you're looking at only are covering interest. Now in the Ponzi phase, what near-term receipts or, you know, the near-term cash flow is really insufficient to cover the interest payments, or let alone the you know, the principal. So you're just covering those payments, those interest payments. So debt starts to increase and accumulate here. So you might ask yourself, well, how are you able to, you know, keep the game going if you can't cover those interest payments? Well, this is where new debt becomes important, and, you know, new ways to roll over debt and refinance, and this is where you start to see fraud in the market essentially, and that's why it's called the sort of the Ponzi stage of the economy. And after here, you have a deleveraging or a bust. A closer look at the hedge phase, what you see is you see low debt levels to cash. You see borrowers are mostly firms and businesses. Business estimates and projections are modest. You see firms generating enough cash to pay these interest and principals, as debt tends to be at a lower proportion of their income. And again, the financial innovation here is low. Long-term loans are mostly at fixed rates. So that's always a good sign, is if, you know, the rates are fixed and they're not going off these ARM or adjustable rate mortgages or adjustable rate loans or whatever. That's when you typically get into trouble. Because once inflation sets in, what you see is interest rates rise, and that sort of seizes up everything. Okay. So in a hedge phase scenario, you have the an app market. So let's take a look at this. Think of when apps first came out for smartphones. There was a boom in app and tech companies, and in Silicon Valley, there's lots of profits here being made from firms and sectors, and of course, investors getting in early at these, you know, introductory levels of rates or what's going on in the market. Even peripheral firms like telecom, infrastructure, so the infrastructure pools, they're making money. Here we go here. Okay. And even commodities like lithium, etc. So at this rate, you're still in a very nascent economy, which hasn't, you know, been sort of tarnished by the sort of the speculative and then Ponzi aspects, which we'll cover now. So let's go on to the speculative phase. So, and here again, what we're looking at is, and we'll go back to the whole scenario at the bottom here. Again, what we're looking at is rising levels of private debt. Cash flows provide enough money just to make the payments on the interest, and these principals need to be refinanced or roll over at a later date. But at least the market itself, you know, is tending to plod along. Individual households take on larger share of national debt, which was normally used by firms looking to make new investments or et cetera. So here, when you're talking about individual households, think of the debts that they might get into. So nowadays we see families becoming house poor, where mortgages and rents are taking up more than maybe 20%, say 20% of their income, their monthly income is what they're spending on mortgage or housing. Again, in this sector, what you see is that financial innovation becomes a bit more aggressive. You see cash flow forecasts being a bit more optimistic. Oh, we're going to make lots of money in the fourth quarter. Don't worry, we've had 3 bad quarters or 3 less than optimal quarters, but we're going to bounce back and we're going to have a good holiday season or something like that. That's typically the sort of optimism that you might see here. More short-term lending, you'll see, thus the more demand for periodic refinancing. Borrowers are at the mercy of these short-term changes in rates or terms or requirements. However, there's still ways to roll over principles at this point. And again, so going back to the whole app scenario, how would a speculative phase look for an app, for the app sector, maybe in Silicon Valley? So you'd have because of the previous app boom, because again, this all goes in a cycle. So again, what you see during this scenario is that because of this app boom, you have the markets growing. There tends to be more attention being placed on this certain sector. So firms want to get in and try to take advantage of the lending and the sort of euphoria that's come into the market. And so there is a sort of speculative nature that they begin to take advantage of. So more firms begin to pop up, some good, some bad, some really with good ideas of, how to work the space, the app space, and, bringing technology and innovation to different ways. So think about maybe Instagram being a very popular app that people tend to use well, or Amazon was able to translate its own apps and things like that. So you do see a lot of good things begin to come into the sector, but you also see a lot of bad things come into the sector. So some people that are just trying to take advantage of the cheap money or cheap access to credit and eager investors. So in the Ponzi phase, again, what we see is alarming levels of debt to income. So if we're going back to some of these apps, again, we could sort of integrate this now, since we should have a bit of an understanding, is that we see that the cash flows that they're getting are unable to service the interest or the principal. So whatever the loan amount was or the investment, they're probably not going to get it back at this point, at least in any sort of short-term or long-term scenario is what we're seeing. There's widespread borrowing against their collateral, whatever collateral they have, hardware or whatever. Debts are short-term and they need to be rolled over frequently via new innovative or creative banking practices. And essentially, what you're doing is recycling and repackaging bad loans at this point. Derivatives begin to come up, other forms of fancy financing, collateralized debt obligations. So those are the sort of the ones that happened during the 2008 crisis. And typically you won't understand these till later on, once they crash, that, they're able to, basically divulge what they've been doing sort of behind the scenes, or, covering up these things. So they're not going to really go out and tell you, hey, look, we collateralized a bunch of bad debts into these packages and then sent them off into the market. No, this is sort of going to happen, surreptitiously, and they're going to enter the market and they're going to be rated at AAA, and they're going to tell you these are great loans. And when they're really typically a bunch of defaulted mortgages mixed in with a few good ones. So that's sort of what happened there. So, and in this point, another interesting thing is that you can't really tell the good ones from the bad ones now. In the early Ponzi phase, that's what you see, and the late speculative phase is that really the bad companies and the good companies are hard to discern. And this is typically what leads to then a bust later on, is as you see a couple of bad apples fail, and these are the early busts in the bubble. And sort of what you have is then investor fear. So again, going back to the app scenario, you have a market that's saturated with investors looking for returns, but nonetheless, it's come to the point where the market getting in is you're coming in, you're buying high, and you're going to end up just selling low, as the turn of phrase goes. So it's really time for firms to start generating these returns that they promised, but many are really failing at this point, and some are even getting caught committing fraud or whatever. So what happens, all hell tends to break loose at this point, as investors and even lenders can't tell winners from the losers because there's so much fraud in the market. And even the fear of, if you're dealing with essentially a defaulted company, it begins to set in. And so markets tend to seize up at this point, and lending becomes scarce, and ways to repackage and refinance old debts essentially is just dried up at this point. So again, this is where the bust happens, the Minsky moment. Bubbles pop, and what happens is that the asset prices stops increasing. So here you can't refinance or roll over the principal if your asset prices are continuing to go down from your other debt levels, your older debt levels. So it's actually going downwards, it's going backwards, sort of the market's retrenching. So deleveraging, you have and what happens to the market? What's going on with the market? What's going on with these lenders, these investors, as opposed to looking at the borrowers? Is they're deleveraging, they're trying to get out of their positions, like, hey, I don't want to invest here anymore. So think about a fraudulent app market in Silicon Valley. Knock on wood, it doesn't happen, but this would be the case. So you'd have a market where they can't tell the winners from the losers, and everybody, because of the sort of the market sentiment, the fear, they're trying to get themselves out. A lot of people are trying to get themselves out. You'd even have like individuals maybe calling up their broker, asking them, hey, are we invested in in these apps? We need to get out. And then so you get a lot of pressure from all sorts of areas coming in on trying to deleverage or retrench. The issue is when Ponzi finance makes a huge enough shock, the whole credit system can come to a halt. And that's what we saw with the 2008 financial crisis. Is the mortgage scandals and the mortgage failures and the mortgage fraud seized the entire system. It brought down Wall Street banks like Bear Stearns, Lehman Brothers. So again, now you're talking a little bit about getting into the weeds more on deleveraging, the deflationary period. Here again, you have the collapse of the Ponzi borrower. And this could also bring down the speculative and hedge borrowers. Hedge borrowers may also find growth or other business projects halted due to credit constraints or lack of investors. So again, what you're seeing is that it could bring down the whole market or the whole economy. It could really seize things up for people borrowing for legitimate reasons, such as hedge borrowers, or maybe those that are on the quasi-speculative ledge, which are still legitimate companies, but they're nonetheless able to pay their bills and continue to kick the can down the road. So the Ponzi borrowers really make it hard for everybody to continue to do business and get lending for legitimate purposes. So banks but the point is that banks and investors are in a period of deleveraging. So it's hard to do anything when that's the whole market sentiment is based on this. And essentially what they're doing is they're clearing out all their bad debts. So there's a lot of fear, a lot of caution, a lot of mistrust in the air. And so that is essentially how good companies are affected. And I think the upshot, going back here for a second. So I think the upshot here is that ideas and market sentiment, not fundamentals here. I'm sort of obscuring that. Not fundamentals are what's driving the deleveraging, especially when you begin to talk about the hedge borrowers or the speculative borrowers. Now, of course, there are some material factors there bringing down those Ponzi borrowers as well. So that sort of kicks it off. So the Ponzi borrower borrows based on the belief that asset prices rise will allow debt to be refinanced. So they can't make minimum payments on interest or principal with the cash flow from investment, only at the appreciating or rising asset value. Again, this requires cheap and accessible forms of borrowing. And you're thinking, well, where's the name Ponzi? A lot of people have heard Ponzi, and it comes from Charles Ponzi, who was an Italian citizen, U.S. citizen, who launched the following scheme in 1918 through 1920, so just before the Great Depression. And how it works is he paid off earlier investors with money from later investors. So that's the same thing in terms of Ponzi borrowing. You're paying off your old debts with new debt. So, I mean, and this is sort of rehashing, since I did sort of talk about this while I went on with the other things, is in the housing